That there are real issues in China now, and they changed really in the last 4 years.
Don't worry, you have clicked on the right video. So I'm just playing a very short interview clip from Bloomberg where Ray Dalio is being confronted about investing in China today. So I'll share my thoughts and exposure later on. And I also like to take the chance to thank Seeking Alpha for sponsoring this video. So sign up with the link below for a 7-day free trial and $25 off their annual subscription. So the price will increase to $299 per year from October 1st. So more about them later on.
Individuals, 70% of their money was in real estate. Real estate has gone down. Stocks have gone down. Salaries have gone down. And as a result, they're not spending and they're concerned and they're holding money in cash. With deflation, cash is a relatively good asset class. That's kind of the household and the business sector is in that state. At the same time, you have the government sector is a problem because most of the government spending, 83% of government spending, is spent by local governments. Those local governments got their money by selling land for real estate. Okay, there are no land sales, and they borrowed a lot of money, and those that they borrowed the money don't get paid. And so the question is, how are you going to get money into those places to operate? It's a situation that's more challenging than Japan in 1990. It needs a restructuring in order to be able to do that. Deng Xiaoping, during his period, said it's glorious to be rich. Is it still glorious to be rich? So you have an environment in China which is changing and becoming a more difficult environment. The innovation, yes, there's fantastic innovation. In terms of technology, there's nothing like it other than in the United States. Europe certainly isn't a competitor in that. However, it's very much government directed. Can there still be entrepreneurship and that inventiveness? These are big cosmic questions for...
Given the environment that you have just painted for us, is China still the place to do business? Is China still the destination for your investment money? You've said time and again that you should be invested in
yes,
China.
I just want to be clear about the investing in China. In all countries, there are cycles and ups and downs and so on. And in no country should you invest so much money that it becomes a dominant portion of your portfolio. So in China, I still invest in China. The question is the size of the investment and how that investment is structured. Investing in China as largely a very attractively priced place that now has a lot of questions regarding the issues that I've just referred to.
In today's episode, we will talk about 3 broad ideas: the current consensus of the Chinese market, my thoughts, and my portfolio allocation. So for those of you who don't already know, Ray Dalio is a billionaire investor and the founder of Bridgewater Associates, which became one of the world's largest hedge funds. And he has always been a long-term China bull. However, you have just witnessed a seismic shift in tone of how he's describing the investment climate in China today. And if I may summarize, it's basically around 3 key issues. 1. They're currently in a difficult environment that needs to go through a major restructuring. 70% of household wealth is locked up in real estate. Real estate has gone down. So wealth has went down, salaries has also gone down. Even general prices are going down due to some mild levels of deflation, which perpetuates the idea of holding cash amongst the consumers today. 2. 83% of the government spending is the local government. They used to get their money from land sales and loans, and there seems to be a standstill there. The current situation is more challenging than in Japan. 3. Every country goes into a cycle, and it doesn't take a genius to figure out which part of the cycle China is in today. The conclusion? China is an attractively priced place with a lot of issues. You must diversify. So if you've told me this set of commentaries came from Ray Dalio roughly a year ago, I wouldn't have believed you. Because Dalio was my go-to perma-bull guy on China. In fact, I just did a quick search on Google. Yes, I still use Google, with the keyword Ray Dalio China. And I see under the news section with headlines such as "Investing in China desirable despite risk." Bridgewater says China's stock sell-off made valuations attractive, unquote, so on and so forth. So these were just reported earlier this year. So what's the sudden change in tone? So I hope that I know why, but don't worry, it seems like the comments under that video got the answer. So the user at DreamGaming393 said, so you know is down when Comrade Ray Dalio is talking smack about the Chinese economy. User at LaurenB.8236 said, China is a great place to invest, but we have only a small part of our investments there. LOL! Exclamation mark. User at Rapture77 said, he can't really say anything. 6.8 trillion US dollars has wiped out in Shanghai and Hong Kong stock markets. 18 trillion wiped out in household wealth in the last 3 years. For perspective, that's almost the same size as the total GDP of China at 19 trillion US dollars and 6 times the size of its foreign reserves. Unquote. Damn, people on YouTube are so damn good. But anyway, just a small point, I'm not trying to blindly defend my fellow comrade, but Ray Dalio from the start has always been focused on his holy grail of investing, which is, in very layman terms, to find 15 to 20 good, uncorrelated return streams. Basically, diversification. Therefore, it's not surprising to know that he has a small part of his investments there, or anywhere for that matter. And on another note, maybe something else to consider from Sir Templeton. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So you tell me where we are currently at. Now, in the name of transparency, this is a snapshot of my current portfolio. So when I glossed over my portfolio over the past weekend, I can't help but have this tingling bittersweet moment. So this portfolio has been close to 4 years in the making. And the best that I could do, a simple return of just roughly above 10%. So I might as well just bought T-bills during the high rates environment. The bitter element is of course the so-called underperformance, whereas the sweet moment comes from the myriad of different learnings, emotional gyration, the experience of actually holding onto a losing stock for such a long period of time. And of course, maybe even a potential recovery, fingers crossed, after so many years, and everything in between. So when someone is greeted by a portfolio like this, I think 2 questions will come to mind. Number 1, are you crazy? Number 2, what are you thinking? Okay, I hope that you're not as harsh, but I get where you're coming from. Firstly, I think this portfolio is very top heavy. I largely concentrate on a few top ideas. So just the first 2 positions actually make up more than 50% of the portfolio. The top 6, it's around 80%. So you might be thinking, this guy sure has some testicular fortitude to sink more than 50% of his portfolio into Chinese technology companies, especially when they were undergoing some of the most trying times over the past 3 years. Actually, this 50% weightage is on a current value basis. As my Baba position has dwindled in size as the price continues to be challenged, on a cost basis, actually both Alibaba and Tencent makes up close to 60% of the allocation. So as the title suggests, my entire China allocation is sitting at 64%. The additional 4% allocation went to this hotpot chain or hotpot company called Haidilao, which has also suffered tremendous valuation pressures as both growth and multiples compress. And likewise for many consumer discretionary companies in China today, so the natural question would then be, why? Why allocate such a big percentage to a seemingly dying market? So truth be told, I don't have a perfect answer either. I really wish that I could come on here to tell you that, hey, 64% is the optimal allocation due to XYZ reasons. But I can't, because there's no reasoning or data to back this up. However, for those of you who have been following me since 3+ years ago, you know that I've been creating content and talking about these 2 companies for donkey years now. In fact, I was 100% into Alibaba for a brief moment. So here's the interesting thing. As far as I can remember, I did not sell any Alibaba shares that I've incrementally acquired over the past 3+ years. But instead, from a portfolio allocation perspective, just added to other names with new incoming cash flow while I build up the portfolio over the years. So the current allocation is just a result of that organic balancing while adding to new names. So the funny thing is, you have people on the internet thinking that if you're not 100% all in into one stock, you're not bullish enough. Heck, 100% might sometimes be not even enough. You must use options or go into margin and have 120 or even 150% exposure to a stock to prove your conviction. So I'm not here to prove anything, but at most just share my journey and learnings. Now, back to the point of why I have 60% in Alibaba and Tencent. It was simply just a number that I was comfortable with. So if you were to convert the absolute dollar value that I've put into these two Chinese tech names, they work out to be right around 6 figures in Singapore dollar value. So I think that's enough for me. Regardless of whether we moon from here or it becomes dead money for the coming decade, I'm okay with either scenarios. Of course, this is barring any unforeseen circumstances on both upside and even downside surprises. So I know that given the recent bottoming process in some of these stock charts, some investors are on sugar high, thinking that we've just bought our one-way ticket to the moon. But I'd just like to remind everyone that this is the current state of affairs, especially for extremely early investors. We've bought the dip, we've bought more dip, and we are just at the early innings of the recovery and LFG. And for experienced old-timers, there has been multiple fake-outs and short-term rallies, which was met with subsequent drawdowns again. I'm more inclined to believe that we are closer to seeing light at the end of the tunnel, and we are inching closer to recovery. So here's my truncated pitch for both Alibaba and Tencent. So I acknowledge that they are currently operating in one of the more challenging periods of its history. But I would argue that the market has already priced this into the stock valuation. In fact, even a little bit more. So if you were to just look at their past 10 years of operational growth and execution, which can easily be extracted from Seeking Alpha's financial tab, they've both managed to grow their business organically and substantially, with more than 8 to 10x their top-line revenue and 4 to 6x their gross profits in that 10-year time frame. And looking at their balance sheet, they're a financial fortress that will not go bankrupt anytime soon. Looking at the earnings projection, Seeking Alpha helps you aggregate the estimates amongst analysts of where they see the company grow its revenue and profits in the coming 3 years, which is important, especially when you're trying to build your discounted cash flow model. And more importantly, you can observe the earnings revision trend, which shows the expectations of growth on the street. So just recently, we see both Baba and Tencent getting more positive revision, which might signal a potential turnaround soon. So looking at ratings, it gives you a sense of how other investors are looking at this company. So in Seeking Alpha, you get to see it from 3 different perspectives. You have the quant rating, which is their in-house methodology using a quantitative approach, crunching numbers and momentum, Seeking Alpha's own analyst ratings, and of course, your Wall Street analyst consensus. So across the board, they're either buys or strong buys, only with the exception of Baba's quant rating displaying a hold. That said, Seeking Alpha also has their various factor grades that you want to consider, such as valuation, growth, profitability, momentum, and revisions, which gives you a bird's eye view of how to look at the company holistically. Lastly, when approaching valuations, you can use the handy charting tool to do the comparison. So I went ahead to check their EV to EBITDA, price to cash flow, and price to sales. And to no one's surprise, they're all near the 10-year low. So we are in a bear market and everything is thrown under the bus. Long story short, the problems and challenges in China today are justified. But since we are in the security selection game, the focus would then be to select companies that are going to be impacted to a smaller extent, while still being able to invest and grow their business and moat over time. So this recent conversation between GIC and Bridgewater sums up my approach to this Chinese exposure.
Makers historically have looked at Japan and sort of said, we don't want to be Japan. And they're very worried about that. But this time, their policy response and so on seems very constrained. I think for long-only asset owners, it's a very different problem. Own Chinese bonds and I start at a low bond yield and I'll get some capital gains. But if I keep investing there, I'll just get that low bond yield, right? So the question is that what you want? On an equities perspective, I think there is a difference between investing in an aggregate index that gives you the whole economy and therefore all the problems that comes with managing an economy and deleveraging versus looking for companies that can still perform well in an environment like this, where you can really translate what is still decent revenue growth, maybe they're even gaining market share, into earnings per share growth.
So a quick plug, I've been an avid user of Seeking Alpha's premium subscription for over 2 years now, and I must say they've really added value to my personal investing journey. And I've managed to learn a great deal from the many contributors in the community. So Seeking Alpha is a community-driven platform designed for investors. Whether you're bullish or bearish on a stock, it doesn't matter. There's a place for everyone. So you'll gain access to research from a diverse range of contributors. And a tip that I always tell my friends is to always spend more time going through articles from analysts that holds a completely opposite view from you. I want to know what I'm missing. And the comments in each research article also serve as a solid supplementary discussion to the case itself. So here's a hack that I also use. After reading through both perspectives posted by analysts on Seeking Alpha, I'll extract one bullish and one bearish piece from writers that I think make a decent argument for their case. Then, I'll feed ChatGPT both articles and get it to summarize and make a combined, more informed viewpoint of the investment itself. And oftentimes, I get a fuller picture of that company on top of my own research. And here's the deal. Right now, if you sign up through my link below, you'll lock in the introductory rate of $214 for the first year of premium membership, plus your renewal will be locked at $239 per year, keeping it a notch lower than all subsequent subscribers. After October 1st, the price will rise to $299. So take action now to lock in those savings. And don't forget, new users get to enjoy a 7 days free trial. You get full access to the platform, allowing you to explore premium features such as their in-house screener, 10 years of historical data on thousands of stocks, market trends and momentum indicators, and of course, tons and tons of investment analysis articles, both bullish and bearish for each stock. So don't wait any further, lock in your rates today with the link below. And thank you Seeking Alpha once again for sponsoring this video. So maybe just to add a little more color of how I view this so-called significant transformation in China today, I'll share a framework that I've summarized from an interview with Li Lu, who's the founder of Himalaya Capital and also a good friend of the late Charlie Munger. So here's how he put it. So the significance of a market is price discovery, basically to allow for prices of financial products to be reflected accurately. So market mechanisms are needed, but government regulations are equally important too. So the financial situation in China today is in the process of great transformation in the next 10 to even 20 years. So they are transiting from indirect finance to direct finance. And indirect means borrowers borrowing through financial intermediaries, like your banks or even secondary market. From debt dominance to equity dominance, and from policy finance to market finance. So don't think of this transition as from 0 to 1. It's a continuum, and they will continue to progress from here after reaping the benefits of the system. So take the whole real estate bubble for example. The percentage of the Chinese GDP from high tech is expected to exceed that of real estate in the next 2 years. And it's pretty impressive when compared to 6 years ago, when real estate was still 2x of high tech. So the government deemed it to be unsustainable and an unhealthy development. Therefore, the interference and guidance. So this view was outlined by Rima. Now, I'm just one of the many voices on this platform. And I observed that many YouTubers tend to get an orgasm talking about the downfall of China and its stock market. So I guess I'm just part of the minority to balance out the viewpoint. And rather than just making videos to earn those ad dollars, I put my money where my mouth is at and tell you what I do, and that this too shall pass. So I know sometimes I sound like a CCP bot that is always supportive. But don't forget, at least you get to watch me encourage and console you through these trying and challenging times. No one encourages me, so I need to stay optimistic for myself. In fact, I'm hearing more bearish noises over the years, which I can only accept. So considering that we now understand the backdrop of the environment Chinese companies are operating in, here are a few good rules of thumb to follow. First, you probably will want your portfolio of companies to have a pristine balance sheet. Heck, don't even talk about pristine. In fact, it will be better if they are overstaffed and they try to be on the safer side of the aisle. You can't go bankrupt if you have no debt, and you need a lot more dry powder and cash and liquidity to weather any tough environment or transition ahead. Second, you want companies with strong brand, a competitive moat, sustainable earnings power, and a track record of execution. I think this is common across any market cycle. It just gives you a better sleep at night. Third, you want to hunt for companies that are unfairly beaten down in this broad bearish market as expectations get adjusted down aggressively. Fourth, you need to ensure that the companies display signs of alignment in shareholders' interests, whether is it through the dividend policy, share buybacks program, management promises, etc. etc. You need to know that you are not compromised while trying to brace this harsh drawdown. And lastly, I'll try to avoid those companies right smack at the center of the crisis, unless they're positioned differently or have a unique advantage. And specific to China's policy finance, I try to align myself to the country's focus of high-tech manufacturing, green energy, consumption-driven, dual circulation, AI, cloud, etc., etc. So with this in mind, I hope that this short episode gives you a better understanding of how I look at the current Chinese investor sentiments and also the transition that they're currently undergoing, and my thought process on why I'm only holding onto the top 2 tech names. So I'll see you in the next video, but more importantly and hopefully, I'll finally see you on the moon. Goodbye.